If you're over 65 and you haven't checked your tax return in the last 30 days, there's a real chance the IRS is holding on to money that belongs to you right now, today, sitting in a return that was filed without a $6,000 deduction you legally qualify for. And heads up, this is general education, not personal tax or financial advice, since every situation is different. Now let's get into exactly what changed, because rule number 1 alone could put over $1,000 back in your pocket this year. Here's the scenario I want you to picture, because I'd guess it sounds familiar. You filed your taxes back in March or April. Your preparer, or your software, ran the numbers, printed the return, and you signed it without reading every line, because who does? Meanwhile, 7 separate rule changes went into effect for retirees this year, some from a brand new law, some from routine annual adjustments, and every single one of them requires you to take an action for the money to actually land in your account. Not one of them happens automatically in full. The Social Security Administration and the IRS are not going to call you and say, "Hey, you're leaving money on the table." That call doesn't exist. The forms exist, the deadlines exist, but the notification does not. For a retired couple living on a fixed income of $40,000, $50,000, $60,000 a year, missing even one of these 7 things isn't a rounding error. It can be the difference between a comfortable year and a tight one. So where does all this actually come from? It's not a rumor and it's not a workaround. It comes directly from federal law and federal agency guidance. The Social Security Administration sets the annual cost of living adjustment under the Social Security Act. The Centers for Medicare and Medicaid Services, or CMS, publishes the Medicare premium and out-of-pocket figures every November. And the senior bonus deduction I'm about to walk you through comes straight from the One Big Beautiful Bill Act, signed into law in July of 2025, which the IRS has since built directly into the 2025 and 2026 tax forms. Everything in this video is sourced from those 3 places: SSA, CMS, and the IRS, not from a blog, not from a guess. Let's go through 7 specific things, one at a time, with the real dollar amounts so you know exactly where you stand. Number 1. Your real Social Security increase is smaller than the headline number, and most retirees never check by how much. Here's the rule. Social Security benefits went up by 2.8% starting with your January 2026 payment. For a retiree who is receiving the average benefit of around $2,015 a month in 2025, that 2.8% bump adds roughly $56, bringing the average check to somewhere around $2,071. That's the number that made headlines back in October when the Social Security Administration announced it. Here's the dollar impact most people miss. At the exact same time your Social Security went up, your Medicare Part B premium also went up, from $185 a month in 2025 to $202.90 in 2026. That's an increase of $17.90, and for most retirees that premium is deducted directly from your Social Security check before it ever reaches your bank account. So your real net increase isn't $56. For a retiree at the average benefit level, it's closer to $38 a month once you subtract the higher Medicare premium. Here's a concrete example. Say you're a 70-year-old widow receiving $2,000 a month in Social Security in 2025, and you pay the standard Medicare Part B premium with no income surcharge. Your 2.8% COLA adds $56, but your Part B premium eats $17.90 of that. Your actual net increase is around $38, not $56. If you never compared your December deposit to your January deposit, you have no idea whether that's what actually happened to you. What most retirees do wrong here is assume the COLA and the actual deposit are the same thing. They're not. And here's where it gets important. If you also pay an income-related surcharge on Medicare, called IRMAA, your net increase could be smaller still, or in some cases, wiped out entirely. Now here's where it gets important. Number 2, if you're paying an IRMAA surcharge based on old income, you may be paying for a version of yourself that doesn't exist anymore. Here's the rule. Medicare uses your tax return from 2 years ago to decide whether you pay extra for Part B and Part D. Your 2026 premium is based on your 2024 tax return. If your 2024 income was above $109,000 as a single filer, or $218,000 for a married couple filing jointly, you're paying a surcharge on top of the standard premium. Here's the dollar impact. The lowest surcharge tier brings your total Part B premium to $284.10 a month, instead of the standard $202.90. That's an extra $81.20 every single month, or about $974 a year, just for Part B. The next tier up brings your total premium to $405.80 a month, an extra $202.90 monthly, or roughly $2,435 a year. And Part D carries its own separate surcharge on top of that, ranging from about $14.50 to $91 a month, depending on your bracket. Here's a concrete example. Say you retired in June of 2024 at age 66, and your final year of full-time work paid you a combined household income of $140,000, counting your salary plus a bonus. That 2024 return is what Medicare is using right now, in 2026, to charge you a surcharge, even though your actual 2026 income might be $40,000 or $50,000 from Social Security and a modest pension. You're paying premium prices based on a paycheck you haven't earned in a year and a half. What most retirees get wrong here is believing this fixes itself. It does not. Medicare will keep using your 2024 income until your 2025 tax return cycles through the normal 2-year look-back, which won't affect your premium until 2027. If you want it fixed now, in 2026, there's exactly one form for that, and I'll walk you through it in the action step. Number 3. There's a new federal deduction worth up to $12,000 that a meaningful number of seniors filed without claiming. Here's the rule. The One Big Beautiful Bill Act created a brand new deduction on top of your existing standard deduction worth $6,000 for each spouse who is 65 or older. For a married couple where both spouses are 65 plus, that's $12,000 combined. This applies to your 2025 tax return, the one most people already filed this spring, and it continues through the 2028 tax year. Here's the dollar impact. For a single senior in the 22% federal tax bracket, a $6,000 deduction saves about $1,320 in actual tax. For a married couple, both over 65 in that same bracket, $12,000 of deduction saves about $2,640. And here's the part that makes it bigger than it looks. This deduction also lowers what's called your combined income for Social Security taxation purposes. If your combined income sits close to $25,000 as a single filer or $32,000 as a couple, shaving $6,000 or $12,000 off your adjusted gross income can drop you below that threshold entirely, making a chunk of your Social Security benefit tax-free on top of the direct deduction savings. Here's a concrete example. A 68-year-old single retiree with $30,000 in pension income and modest Social Security has a modified adjusted gross income well under the $75,000 phase-out threshold, so she qualifies for the full $6,000 deduction. If her preparer applied it correctly, her 2025 tax bill dropped by roughly $1,300. If it wasn't applied, because her software was outdated, or her preparer wasn't yet fully briefed on a law that passed mid-year, she overpaid the IRS by that same amount, and nobody is going to volunteer to send it back. Now here's something most people don't realize. This deduction is not available to everyone at every income level. It starts phasing out once your modified adjusted gross income crosses $75,000 for a single filer or $150,000 for a married couple, and it disappears completely at $175,000 single or $250,000 joint. If your income sits right around that $75,000 or $150,000 line, a small adjustment to when you take an IRA withdrawal or realize a capital gain can be the difference between keeping the full deduction and losing part of it. What most retirees get wrong here is assuming their preparer automatically caught this because it's new tax software stuff. Plenty of returns were filed correctly, but early in the filing season, before every preparer and every piece of software had fully absorbed a law that passed mid-2025, a meaningful number of returns went out the door without it. Number 4. Your prescription drug costs are now capped for the year, and most seniors don't know if they've already hit it. Here's the rule. As of 2026, every Medicare Part D plan and every Medicare Advantage plan with drug coverage has a hard annual cap on what you pay out of pocket for covered medications, $2,100. Once you've spent that much in a calendar year, your covered prescriptions cost you nothing for the rest of the year. This applies whether you're on a standalone Part D plan or a Medicare Advantage plan. Here's the dollar impact. Before this cap existed, seniors on medications for cancer, rheumatoid arthritis, or certain heart conditions could face $8, $10, even $15,000 a year in out-of-pocket drug costs. That exposure is now capped at $2,100, full stop, for covered drugs on your plan's formulary. Here's a concrete example. Say you're 72 and you take a specialty medication for rheumatoid arthritis that used to cost you several $100s a month in copays. If you filled that prescription every month starting in January, there's a real chance you cross the $2,100 threshold sometime in the spring. From that point forward, every covered medication should cost you $0 at the pharmacy counter for the rest of the year. 9 months, potentially, of free medication. Here's the part they never tell you. The pharmacy doesn't always know instantly that you've crossed the cap, and plans occasionally keep charging copays past the threshold due to a processing lag. What most retirees do wrong is pay the copay without question, assuming the pharmacy's number is always right. It's worth checking your actual year-to-date spending directly with your plan, not just trusting what the register says. Number 5. If your income is modest, there's a program that can wipe out most of your drug costs entirely, and it's dramatically underused. Here's the rule. The Extra Help program, run through the Social Security Administration, provides additional assistance with Medicare Part D premiums, deductibles, and copays for retirees with limited income and resources. It's a separate program from the $2,100 cap. It works on top of it for those who qualify. Here's the dollar impact. For seniors who qualify, Extra Help can reduce your Part D costs to just a few dollars per prescription, or in some cases, eliminate them almost entirely, well before you'd ever reach the annual cap. Roughly speaking, this is generally available to individuals with annual income in the low $20,000 range, and couples somewhat higher, though the exact thresholds and resource limits are set and updated by the Social Security Administration, so your specific eligibility should be confirmed directly with them. Here's a concrete example. A 74-year-old widower living on Social Security and a small pension with income under the program's threshold applies through the Social Security Administration and finds his monthly drug copays drop from around $40 per prescription to just a few dollars each. Over a year, on multiple medications, that can add up to hundreds of dollars in savings, on top of whatever benefit the $2,100 cap eventually provides. What most retirees get wrong here is assuming a program with Extra Help, in the name must be complicated, means tested in some intrusive way, or not worth the paperwork. The application is a single form. It can be done online or by phone, and for anyone living close to the income threshold, it's worth 10 minutes to check. Number 6. If your 2025 return really did miss the senior bonus deduction, you have years to fix it, but every month you wait is a month the refund sits with the IRS instead of in your account. Here's the rule. If you already filed your 2025 tax return and the senior bonus deduction wasn't applied, you don't have to wait until next year to fix it. You can file an amended return using Form 1040-X, and the IRS gives you until April 15, 2029, to do it for a 2025 return. That's a wide window, but the money doesn't grow while it sits unclaimed. Here's the dollar impact. If a single filer in the 22% bracket missed the full $6,000 deduction, that's roughly $1,320 sitting with the IRS instead of in a checking account. For a married couple who missed the full $12,000 version, that's roughly $2,640. And if that deduction also would have pushed some of their Social Security below the taxable threshold, the real number could be several $100s higher than that. Here's a concrete example. A 69-year-old retired teacher filed her own return in February using software she'd used for years before it had been fully updated for the new law. She paid roughly $1,100 more in tax than she needed to. When she checked her return against the current IRS guidance in June, she realized the deduction line was blank. Filing a 1040-X doesn't require redoing the whole return. It only requires correcting the specific lines that changed, plus a short explanation. What most retirees get wrong here is assuming an amended return is a red flag that invites extra scrutiny, or that it's not worth the hassle for a few $100s. Amended returns claiming a documented, clearly defined deduction that simply wasn't applied are common, and the paperwork is a fraction of what most people expect. Number 7. If you're also having federal tax withheld directly from your Social Security check, this new deduction might mean you're overpaying every single month, not just once a year. Here's the rule. Some retirees choose to have federal income tax withheld from their monthly Social Security payment using a form called the W-4V, so they don't owe a big lump sum at tax time. That withholding rate is usually set based on old assumptions about your tax liability, assumptions that may no longer hold now that the senior bonus deduction is in place. Here's the dollar impact. If the senior bonus deduction drops your federal tax liability close to zero, but you're still having, say, 10% withheld from every Social Security check, that money isn't lost, but it's sitting with the Treasury instead of covering your monthly grocery bill or your utility payment. For someone receiving $2,000 a month with 10% withheld, that's $200 a month, or $2,400 over the year, tied up until you file your return and claim it back as a refund. Here's a concrete example. A 75-year-old widower has modest pension income, a small required IRA withdrawal, and Social Security. Once the senior bonus deduction is factored in, his actual 2026 federal tax liability is close to zero, but he's still withholding at a rate he set 5 years ago before this deduction existed. He's essentially giving the IRS an interest-free loan every month, then waiting until the following spring to get it back. What most retirees get wrong here is treating their W-4V withholding election as something they set once and never revisit. Now here's where it gets important. That election can be changed at any point during the year, simply by filing a new W-4V with the correct rate, or by electing not to withhold at all if your recalculated liability supports it. Let me connect these 7 together, because here's the thread that runs through every one of them. None of this is a loophole. None of it requires aggressive tax planning or a workaround that might raise a flag somewhere. Every dollar in this list is money you are already entitled to under current federal law, the COLA under the Social Security Act, the IRMAA recalculation under Medicare's own rules, the senior bonus deduction under a law Congress passed and the President signed, the Part D cap under the Inflation Reduction Act's phase-in, and extra help under a program the Social Security Administration has run for years. The only thing standing between you and any one of these is a specific form, a specific phone call, or a specific comparison of 2 numbers. Every single benefit I just described requires an action from you. The COLA arrives automatically, but knowing your real net increase requires you to compare 2 deposit amounts. The IRMAA overcharge fixes itself eventually, but eventually means up to 2 years from now unless you file a specific form. The senior bonus deduction is sitting right there on the 2025 tax law, but only shows up on your return if it was applied correctly. The Part D cap protects you automatically once you cross it, but knowing when you crossed it requires you to check. And extra help exists whether or not you ever apply for it, but it only helps you if you do. So here's your one action step for this week, and I want it to be specific. Go to ssa.gov and pull up your actual January 2026 Social Security deposit next to your December 2025 deposit. Write down the real difference in dollars. Then, if that number looks smaller than expected, or if you retired in the last 2 years and are still being charged a Medicare surcharge based on old income, search for Form SSA 44 on ssa.gov. That's the specific form that lets you report retirement as a life-changing event and get your premium recalculated based on where your income actually stands today, not 2 years ago. That one form, filled out and submitted this week, is the single highest leverage thing on this entire list for anyone who retired recently and is still paying a surcharge from their working years. If this actually helped you check something you hadn't looked at, subscribe, because I put out a new video like this every week, walking through exactly what changed for retirees and exactly what to do about it. And next week, we're going deep on required minimum distributions and the specific ages where the IRS rules shift under you without warning.